Here we have exercise 232, which is pretty easy to earn all of the points for this homework problem because you can simply guess on the answers and you've got your 5 tries, but it's really important to understand why the answers are what they are. So starting with transaction 1, the company issued par value preferred stock for cash at par value. So whenever a company sells stock at par, we're just going to debit cash and credit preferred stock. So our capital stock account, preferred stock, will increase as a result of that entry. But we're not going to credit paid in capital in excess of par because we sold the stock just at par value. Also, retained earnings wasn't part of that journal entry, so there's no effect on either retained earnings or the additional paid in capital account. However, in the second transaction, here we sold common stock for cash at an amount greater than par, so we would debit cash for the total amount received, credit common stock for just the par value, so the capital stock account, common stock, will increase. But then this will increase also because we're going to credit paid in capital in excess of par on the common stock. Again, retained earnings is not impacted by this transaction. In transaction 3, we're completing a 2-for-1 stock split. And remember, stock splits don't require any journal entries, and therefore there will be no change in any of these balances. There couldn't be a change because there are no journal entries. So the only things that change with a stock split are the par value and the number of shares outstanding. And this question is just asking for the change in the balances, which there would be none, and that's why it's no effect. In transaction 4, the company declared a small stock dividend, and that's the only type of stock dividend that you're required to know about in this class. And when the stock dividend was declared, the market value was higher than par value. So the easiest way to answer this question is to think about the journal entry that you would make. We would debit stock dividends for the market value of the stock at the time the dividend is declared. And stock dividends are going to be closed into the retained earnings account, decreasing retained earnings. So therefore, the impact on retained earnings of that transaction will be to decrease it. And then when we declare a stock dividend, we credit common stock dividends distributable for the par value, and ultimately, when those new shares are issued, we debit common stock dividends distributable to get rid of the amount, and credit common stock for the par value. So ultimately, the common stock account is going to increase, and that's part of the capital stock section. Also, since we are declaring the stock dividend when the market value is higher than par, we're going to end up crediting paid in capital in excess of par for the difference between the market price and the par, which is why the additional paid in capital amount is going to increase. In transaction 5, we declared a cash dividend. Cash dividends, we debit cash dividends and credit dividends payable. So the debit to cash dividends, that's ultimately going to decrease our retained earnings, but neither of these are impacted. In transaction 6, we issued the shares of common stock required by the stock dividend declaration in part 4. And remember here, all we're doing is debiting common stock dividends distributable to get rid of it, and crediting common stock. So there's no impact on any of these amounts. And that's because common stock dividends distributable, because they change into common stock. When we switch out one for the other, there's no impact. In transaction 7, we issue par value common stock for cash at par value. Well, this is very similar to the first transaction, except we're dealing with common stock rather than preferred stock. So the answers will be the same as in the first transaction. And finally, here we paid the cash dividend. That has no impact on any of these items because we would simply debit dividends payable and credit cash. Dividends payable is a liability. Cash, of course, is an asset. So there's no impact on any of these stockholder equity accounts.